frustration. So what you've seen is a shift out of that, and Michael helped us find a strategic who really came and invested in 2009, and still in a very difficult economic time. But the fundamental shift has been away from this kind of, I said it earlier, this dot-com idea that you just raise a bunch of capital, you can hire a bunch of people, you can create some new technology. If it doesn't work the first time, oh gosh, that's too bad, go try again. To now a model that is very, what I would describe as capital light or asset light. In other words, not a lot of investment in heavy infrastructure, not a lot of investment in technology developments. I mean, at Prometheus, I keep looking to Andy here. Andy's at Prometheus now. He was a key player there on the finance side of the business, a great asset to that company. But as Andy knows, I mean, asset heavy, you've got to spend a lot of money putting into building plants and infrastructure, hiring lots of people for R&D, and you burn cash without producing any. So when you move to an asset light model, you try to direct your cash into areas that produce revenue. And the sooner you can do that, the better. And certainly in my new life, I get to be on the other side of the table, which is a lot more comfortable, quite honestly, than that side, where you have a little money instead of begging for it all the time. I mean, you're really looking for companies that have that focus, that are very, very disciplined, that are looking at ways to generate cash as soon as possible in the business model. And I think you're going to see that continue as you go forward. I mean, we hear all the talk of all the cash.
But at the same time, there's all this cash money. So, but at the same time, if there's no technology risk, I mean, if there's a big capital-intensive project that really works, that there's there's no technology risk, and you're highly confident in cash flow, then in some ways the bigger the better, right? I mean, because there's all this cash that they want to put to work.
No question. I mean, it's an interesting dichotomy because there's all this cash, but at least funds like the one I'm involved with, Black River in general, they're looking for asset-light type models that generate cash more quickly. And at the same time, you have these piles of cash that need to play. And so, as Mike could point out, there are bigger opportunities as well. It's certainly beyond the scope of us, but there are players who are looking for billion-dollar opportunities or several $100 million opportunities to play. But the technology development, from our perspective, has shifted away from some of these companies in that $10 to $20 million range to companies that the angels are investing in, or that can actually get the government money to fund that technology development. And that, at least from our perspective, are the folks who, for those other folks who ought to be funding that, they're better suited for that than we are.
I mean, it's interesting from just kind of the broad investment world. From the state perspective, we are seeing a lot of these big institutional investors so hungry for uncorrelated assets. Could you please find me some asset that doesn't move with the business cycle? Because now everything, you used to have your bonds and your stocks, and they would go like this, and your portfolio would look like that. So now they're all going like this. So we hear there's lots of talk about infrastructure. How can we find infrastructure-based assets, things that have steady cash flow, it's going to be predictable, and so I think there is potential. I mean, there's conversations going on about. So are there ways that you can make energy efficiency look like an infrastructure investment, and then you could get that scale. People would say, yeah, this could really work. There's a technology risk, and so I think there continue to be conversations about how. There is this money on the sideline. Can you find really low risks, not super high return, but kind of bond-like, payments that would work for portfolios that really are looking for cash flow?
Yeah, so we're working on a couple like that, and they've been going on for almost a year. I think they'll get done. It's just that fear is so great from the investors that they are just crossing every T and dotting every I to make sure there's no risk, particularly around execution. It's just the burden is so high around execution risks that it's tough. They're going to get done, but it's we're going on a year getting these two projects.
And what you see is that companies will get a limited amount of money and have to prove that execution.
Stage financing.
And and then they'll get and then say, okay, we did this, we de-risked it to a certain extent, and we get more. I mean, Green Canopy Homes here in Seattle, it's an interesting company because and I have a relationship with them, but for full disclosure, but they received some money by Northwest Energy Angels. It's energy efficiency play, arguably very low risk. I mean, there's really no technology risk. They're buying existing,
flipping homes.
They're buying
and greening them up in the process.
They're buying existing, but they don't like the term flip.
I'm not a marketing guy.
They buy residential homes and they, do an energy retrofit, really, radically reduce, the cost to operate the house, and super lower the carbon footprint, and then they don't sell it at market, at par with the rest of the market. So they really have, it's fascinating, it's disrupting the real estate market because they sell at a par. So it's a greenhouse that sells at a comp to a non-greenhouse. So the time on the market is very short. So here it's an interesting, fusion of what, the panel's been talking about, low risk, energy efficiency space, and something that, focuses on execution where, the entrepreneur can prove out that execution in a really fairly near time horizon to be able to get more equity.
I should say, we love that model. I mean, from a policy perspective, it does a bunch of really great things. You got vacant homes that need to get refurbished, so they get refurbished, so you're employing people doing that, and then they're doing a deep energy retrofit at the same time, and so you're getting this long-term benefit in terms of, taking our existing building stock and, bringing it up actually past current code. So there's a lot to like, just from a policy standpoint, we like about their model.
Just to show you how focused investors are on execution risk. We closed earlier this year, last February, $150 million financing for a company in Ottawa by the name of Cascadia Energy. The investor spent $4.7 million on diligence. Lawyers, engineers, consultants, you name it, $4.7 million. They crawled up and down that company. Every single aspect of that company was torn apart, examined. It just tells you how focused investors are on what can go wrong and making sure that they do complete diligence.
And energy and angel groups actually have formed pretty sophisticated due diligence processes to really dig in and understand the risk. So at the smaller end, they're doing the same thing. And at the large end as well, if you have anything to do with DOE, loan grants and funding, what happened with Solyndra really threw a wrench in the whole process. Because a lot of people don't really understand portfolio theory, but the Solyndra really slowed down a lot of DOE subsequent lending. A lot of companies, hundreds of millions of dollars of funding. Now Congress has independent audits. If DOE is doing an audit, they have third-party independent auditors to audit that process to make sure nothing's wrong because it's Solyndra. So it's just become crazy. So that's kind of the hyper-risk aversion. That will probably go away eventually.
The other point I would make about, again, things that in my mind have changed since 2008. So one, I think, the perception of, people are really risk averse, and their perception of policy risk has really gotten up as things have gotten, flakier around some of these policies, that when you have a business model that really depends on federal or state policy. The other thing is that what we're seeing is, clean energy popping up in the most surprising places, like Boeing. Right? I mean, the 787, is 20% more energy efficient than its competitor in the market. I mean, I tend to think of those as green jobs. Those are like, that is a huge win. And so there's like, so composites, lightweighting transportation. You've got BMW, building this carbon fiber plant out in Moses Lake, which really is a game changer that you're taking about, technology that was used for aircraft, highly customized, super stealth fighter jets, and you're getting the cost down to the point where you could actually imagine that in a production automobile. That, like, the opportunities that creates for lightweight, all kinds of things that pencils just on a pure market basis is, to me, really exciting. So I think that's, I think the state's view of what constitutes, clean energy, green jobs really is expanding, and it touches a lot of different parts of the economy.
Thanks, Dan. I'll ask one more round of questions, and we'll try to open up to get everyone's involvement. A couple of things come to mind. I mean, we are certainly at a different age. I mean, right now, from our standpoint, working with a lot of institutional clients, private, you have low interest rates, high volatility, high correlation of assets. It's a very different game, and we know it's going to be also changed, so it also speaks to new trends. As I can kind of hear, obviously there's more markets moving cycles. And the next pattern is right now we're seeing a move more towards gas-based. And hearing what Kirt's saying is low asset base operations and business models really speaks to cash velocity. basically investment velocity.